Welcome, everybody. It's great to see so many of you joining us today. I am Shelley Rogers, and I am part of our web team here at Liberty Fund. It is our pleasure for you to join us today for the latest installment of From the Shelf with Curator Arnold Kling. Before I turn it over to Arnold, our distinguished guest, Leonidas Zelmanovitz and Nicolás Cachanosky, will have a discussion with Arnold for about 20-30 minutes. And then we will turn it over to you guys for live questions, and I'll allow you to go live when that time comes. Arnold, take it away.
Okay, so the book we're talking about is Better Money by Lawrence H. White, and it tries to compare, I think, three monetary regimes: a gold standard, a fiat money standard, and a potential Bitcoin standard. And from a sort of a libertarian point of view, you can ask, is one of these standards more conducive to liberty or not? And I think you have to try to address the tangled relationship between money, banks, and government in order to formulate a point of view on that. I guess I'll start with the traditional definition of money, which is a means of payment, a unit of account, and a store of value. So I think in principle you could separate all of them. You could have a unit of account that's just kind of, you can imagine a central computer that measures things in dollars, or you could even imagine a country with a very unstable currency where, for all practical purposes, they choose dollars as their unit of account, just because that if your peso is depreciating at 10% a week, it's probably easier to quote prices in dollars. So you can have a unit of account that's not your means of payment necessarily. You could have a means of payment. I think of a credit card as a means of payment that's not really a unit of account. It's not a store of value. And you could have a store of value that's not a means of payment or a unit of account. So I'm doing this from the porch of my house. My house is a store of value, I hope, but it is not a means of payment or a unit of account. So I wonder if you have any comments on that traditional view of money and what that means in terms of gold, fiat money, or a Bitcoin standard. Leo, do you want to take a shot?
Yeah, yes. Arnold, this idea of separation of monetary functions that you just mentioned is a possible way for the development of a monetary system in our countries, in Argentina and Brazil. We had experiences in which moments in which the medium of account was not the medium of exchange was not a good store of value nor a good unit of account, and then it was replaced at sometimes spontaneously, sometimes with the agreement of the government. So authorized by law, either by a price index or by foreign exchange, the US dollar, for example. So this is a way to solve the problem of a medium of exchange that's not performing well the other two functions. But there are transaction costs for doing that. And that is something that needs to be taken into account.
Okay, Nicholas, do you have any thoughts on that?
Well, yes, as you mentioned, some countries have historical problems, long-standing problems to have good money. I think of money as the good that we commonly use as a medium of exchange, like a peso, or a real, or a sol, or one of these currencies, but some of them are really bad stores of value. And that creates a very problematic, a very serious problem. If you live in these countries where you don't have good money, you have to use bad money for your transactions, or at least some of them. But then you have to have a secondary, on the side, a parallel economy where you use a better money, like the US dollar, the euro, or something else. And that becomes quite a challenge, not only for everyone doing business to have to think in two monies at the same time, but also for the government who's trying to run policy for better or worse, efficiently or not. And they manage one money, the bad one, the peso, and the market is trying to move to another one that they don't control. So everything becomes very difficult. To use Leo's terms, the transaction cost on these problems is higher than it should be. And there are different ways you can get out of this. One is, for some reason, the government starts to do a good job at managing their own money. For instance, in the 1990s, after going through an hyperinflation crisis, Peru kept their own currency and managed to lower inflation. In other cases, they have to, in a very bad situation, give up their own currency, like Ecuador did in 2000, and just, abandon their own currency, the sucre, and adopt a foreign currency like the US dollar. I think what Larry is doing in the book is comparing three big standards. Like you were mentioning, the old gold standard, the current fiat money standard, and then Bitcoin as an example of cryptocurrencies. So as we think of where is the future of money going in the next 10, 5, 15, 20 years, and there's going to be a major change in how money is managed, what are ways to go from our standard to a better standard that will be more stable, more secure for individuals, and so on?
So that maybe brings up the subject of the entanglement of money and government, because I think it's historically always been entangled, but under a gold standard, the government is, let's say is just issuing gold coins, and gold coins can serve as a unit of account, means of payment, store of value, and be relatively stable. The one risk of that a creditor of the government has is if the government just doesn't have enough gold to pay its debts, it can default on the debt. So, from that standpoint, it seems like, that gold has an advantage. Now, Keynes famously called gold a barbarous relic, and there are a lot of, you're looked down on today if you like the idea of a gold standard. Any views on sort of why a gold standard went out of favor, why it should go out of favor? Leo?
Arnold, under a gold standard in which there is a monetary base that is gold, that is expensive, and there are money substitutes that are banknotes issued by the banks or eventually even by the government itself. If the monetary base is expensive, there is inbuilt in the system an incentive to economize in the monetary base. And then you can understand all the history of how the gold standards evolved and eventually were abandoned as different stages in this process of economizing in gold. So first, all transactions were in coins. Then they start to be some of the transactions done in bills of payment, then in banknotes, then in credit accounts, then gold became only redeemable through between among banks, then only among central banks, until that the money was not redeemable in gold at all. So if we accept that there is this inbuilt incentive to economize in gold, the incentives for the economic agents is to abandon gold. And that's what happened. And that's what happened, the historical evidence. You may like that or not, but if we come back to a gold standard, the incentives will be there. And it's not difficult to predict that the same thing will happen again.
Well, I think what Larry says in the book is that the evolution, yeah, sure, people want to abstract away from gold. You don't want to have to carry physical gold. You don't want to have to measure it, make sure that you're getting real gold, make sure that the weight's okay. So abstract paper is superior, and now we abstract even to computerized money. So we abstract further. But the interesting step that he points out is going from fiat money that is defined, or going from money that is defined in terms of gold standard. So if I have a paper dollar that is worth, 1/40th of an ounce of gold or whatever, then that's even though it's abstract and it's not physically gold, it still works with a gold standard. But when the government says the value of the dollar in terms of gold is flexible, it can vary, then you don't have, at that point, you've really departed from a gold standard. And I think he thinks that that's the step that the government always takes. And I don't know if private banks would take that same step with their banknotes or not. Just say, okay, and my guess is they have an incentive to do that, right? You issue banknotes and you say, maybe I won't back them with gold. Maybe I'll just issue lots of banknotes because it seems to work. And I guess the big incentives for government to do that are when it's desperate to spend. So he gives the example, the First World War was really when governments converted from gold-backed money to pure fiat money. So that would, so it's, for private banks, it's kind of the incentive to engage a little bit of seigniorage and sort of getting the profit from issuing notes without backing them. In the case of government, it's the incentive to deficit spend that undermines the willingness to stick to a fixed value of gold to currency. Nicholas, do you have comments on that?
Yeah, well, one comment, you just mentioned something very close, why we see the government stepping out of the gold standard. I think on one side there were incentives. The gold standard is an institutional constraint for the government to impose like an inflation tax, extract rent from their people and so on. But also we had an historical event. The gold standard broke down with World War I. And it's hard to say that, that event was because of the gold standard. So it's not that the gold standard was unsound, not consistent or things like that. Just World War happened and the gold standard was set aside, which is different from a canonical story where the gold standard was present during the Great Depression and it caused the Great Depression and that line of argument. If you look close at history, that doesn't hold. So if you want to put a day or a moment where gold standard dies, I will say World War I. Eventually, just to clarify, that was replaced by something different called the gold exchange standard. Even if the name is similar, the system was quite different. So I wouldn't say that we went back to a gold standard. that was eventually abandoned in 1971, the famous event where Nixon closes the gold window. But the other point that I wanted to mention, and this goes, I think, to the core of some of Larry's points, is that when you think about money supply, you have two big components. On one side, you have what we may call the primary creation of money, which is where is base money coming from, monetary base. Then you have the secondary creation of money, or what we sometimes call the money multiplier. And this happens as base money goes into banks, then there's a secondary creation of money. So total money supply has a primary component and a secondary component. There's a reason why we call them primary and secondary. The secondary depends on the primary. So under the gold standard, the management of how much is your base money, your primary source of your money supply, is a market outcome. You have gold miners that have to compete in the market, and they're going to want to produce more or less gold depending on what the market prices are for gold and so on. When you move from the gold standard to fiat money, that market incentive goes away. So now the central bank needs to find a way to decide what the right money supply will be. What should be the monetary anchor? How are we going to decide how money supply is going to behave? And because you don't have the market process information to give you a feedback of whether you're doing a good or a bad job, central banks tend to make mistakes. And there's a very interesting work actually by Larry White, George Selchin, and Lastrapes, where they compare the best performance, not the average performance, the best performance of the Federal Reserve managing fiat money with gold standard. And gold standards outperforms fiat money. And the reason is there is no clear mechanism, information to tell the central banks when they're doing a good job or a bad job. Looking at price levels and other, economic indicators are a substitute for how the market used to manage the monetary base. So that's an important point, and that's what Larry, I think, is trying to get at the book. How we go to our money to better money, we need to find a good solution to how money supply is going to behave.
Yeah, so this is a big controversial issue in economic history. Sort of was the abandonment of the gold standard during World War I, and was that necessary? And then was the attempt to restore something like a gold standard, was that a huge mistake? So that, so Winston Churchill was Chancellor of the Exchequer. This is around, I guess, in the 20s, and decides that, we ought to go back to the old pre-war gold parity. It's the right, honorable thing to do. It will make, the British Empire trustworthy again. And the verdict of a lot of economists, Keynes especially, was that was a disaster, that Britain really couldn't sustain pre-war parity. And then a lot of conventional historians then go on to say that other countries attempting to maintain some semblance of the gold standard caused the depression. I guess the evidence being that the sooner countries went off the gold standard in the 1930s, the faster their economies recovered. So what do you guys say about that? And what does Larry White say about that? Let's start with Leo.
Well, there is a quote from Mrs. Arnold, in which he says that to restore redemption of gold standard money at the same parity of before a bout of inflation is the same thing of running with a car over someone and then trying to correct your mistake by running back over the guy again. Okay, so one problem was the fiscal need to pay for the war be that justified or not, that's not the point here. It happened both in Germany and in England. So during the First World War, one thing is the fiscal need to inflate in order to bring to the government all the resources needed to fund the war effort. The other thing is how to restore redemption. The French, for example, they accepted an 80% devaluation when they came back to the gold standard in the 20s. The gold, the exchange standard, as Nicolás mentioned. But anyway, they return without the problem of forcing deflation on prices on the entire economy. But neither England nor the United States did that. And so that was a different problem of returning to the gold standard. Is returning to the gold standard, running the car back over the guy in order to fix your mistake. So all the trauma of the inflation that during the war years was double, or if you can, if you want to say, even at a higher potency, it was even more painful to force the adjustment of prices to the previous parity, and that it was solved in one way or another with the depression and the abandonment of the gold standard.
Yeah. So the world recently had not World War I, but the pandemic, the COVID episode. And in some ways, it seems to me the governments reacted the same way, running very large deficits. But I guess this happens under a fiat money regime. So how does that create different results, or does it? Or I guess with, or in World War I, we sort of instantly created a fiat money regime, so maybe it's more similar. Leo, you want to take a shot at that one, or
Nicolás?
Sure.
Okay.
Evidently, Arnold, we don't need to return to the parity before COVID, to the price level. We don't need to return to the price level before COVID. But imagine if that was what we wanted.
Right. People complain about the Fed now maybe being too tight, just trying to get the inflation rate down. Imagine trying to get the price level back. That would be really severe.
Yeah, and that's what the British and the Americans did or tried to do after the Great War.
Yeah. Nicolás, do you have any?
Well, on this topic, I wanted to add that you can track the Great Depression to a chain of events that starts at least with World War I. It's not that the Great Depression fell from the sky and we made a monetary policy mistake. There was a big issue. The gold standard is not a national monetary policy, it's an international monetary policy. All the countries in the gold standard share the same base money, gold, even if inside their borders you have your own central bank notes in circulation. So when we think about the gold standard, it's not a national system, it's an international system. And that's what broke down with World War I. So when countries start to go back and they do it wrong, that's hard to say that that's the gold standard fault, what led to the Great Depression. Now, if you go and see how especially the Federal Reserve is behaving in the years prior to the Great Depression, they're not following gold standard rules of behavior. They're following something different called the real bills doctrine. So even in their mentality, they weren't playing gold standard game. The real bills doctrine asked for a different behavior. To simplify the issue, The idea is that money supply should track closely movements in output. And that can be problematic because if you see output falling, your inclination is to let money supply fall, and maybe you shouldn't. And that's the point that Leo is mentioning. You make a serious mistake, and that's the reason why the crisis was so bad. And we need to remember that on top of this, then we had a whole set of regulations on the New Deal. So it's hard to say the problem was just the gold standard. There were a lot of things going on at the time. Now, in going to your COVID question, it's interesting that today is easier for governments around the world to shut down everything and finance you by printing money. If you are in a commodity money regime like gold, silver, or anything like that, you cannot go to a printer and say print gold. You have a real world constraint there, right? So these kind of policies where I can go to extremes and then compensate you monetary is easier in the fiat money regime. I would say the inflation we are seeing today, it was an overdoing of those monetary assistances. So if you look at the trend of nominal income, you will see champs when we shut down the world, and eventually we'll start to see the high inflation today. Now, in this event, we are seeing a Fed, I think, reacting late and maybe too strong because they're acting late. So it's a problematic situation for any central bank trying to deal with this.
So, so we talked about the history of a bit how we got from a gold standard to fiat money. Governments basically desperate to finance war efforts, and I guess deciding not to use the other means of regular taxation or borrowing. How might we evolve to a Bitcoin standard? I have a problem imagining it just because I don't see any incentive for governments to evolve to it, although I guess a couple of governments have, or at least have sort of encouraged, some governments have encouraged the use of Bitcoin, even in government to civilian transactions. But it seems to me like the government doesn't want to lose its incentive to just print money to pay for things. So that leaves the incentive to private agents, and I'm not sure if that that requires an awful lot of coordination and willingness to perhaps defy governments to do that. Any thoughts on getting from here to a Bitcoin standard, and what whether that's a plausible scenario? I'll start with Nicholas.
In the narrow sense of moving specifically to Bitcoin as a new money, I see that difficult. In a broader sense of moving from fiat money to a cryptocurrency, Bitcoin 2.0 or something else, that's more of an open question. And I see there can be a number of issues, but two of them that are important. If we leave aside technical challenges, a well-known technical challenge of Bitcoin is how fast it can process payments.
Right.
So let's say we solve those technical problems. There are still two conceptual issues. One is that money is a network good. So the more of us are using the same currency, the more we benefit, which means switching from one network, the US dollar, to another network is costly if you are the first mover. So having a money transition is not that easy. It happens when you have like a major crisis or something like that disrupts the system. So it's not easy to imagine that just because we have a cryptocurrency that is more efficient than fiat money, we will change. It's not just about being a better good, it's about the network effects. So anyone who is developing a cryptocurrency, hoping that it will become a seriously, seriously money at the large level, needs to deal with the problem of the network effects. It's not enough to have better money.
Yeah, that may be why Facebook thought that they would embark on something like that.
Yes,
Because they
right.
have a network. And
The
they
other
have
issue
experience with it.
goes back to how should base money behave. And in Larry's book, we have three cases. We have gold, we have fiat money, and we have Bitcoin. Gold represents a case where base money is a market outcome. Fiat money is a case where the base money is the outcome of a policy decision. Bitcoin represents a case where base money outcome is a strict rule, meaning you cannot change it. So the problem I see there is that Bitcoin's rule is designed to have volatility. That's why we see the price going up and going down and so on. And the rule you want for good money is stability. Bitcoin is designed to become an asset for financial investment, right? To buy cheap and make money selling later. That's why people buy Bitcoin. It's not designed to give you stability. So I see a hard time becoming Bitcoin becoming money. Today, I see it more as an investment asset and as a payment technology, which is not the same than money.
So how would you design a cryptocurrency that for stability?
Well, that was my next comment. That's not easy. It's very easy if you're coding a cryptocurrency to go into your coding and say money supply equals this amount or this formula. Like on time, it has to grow a certain rate. That's very easy. But to create a behavior that is tracking money, making money supply track money demand, that's not easy. And you have to, so far we know of two ways out of that. One is let the market sort that through prices. Two, if you don't have a gold standard now, you have fiat money, and that needs to come from a central bank, then you need to have someone making that decision, a committee, a central bank president, or someone. So the challenge that the crypto world has to create good money is how they replicate a market process.
I remember years ago, Robert Hall was trying to figure out what correlated best with inflation. And I think he found a set of commodities. It might have been 4 of them. Copper was one of them, and maybe some kind of lumber. So maybe one approach would be to have a cryptocurrency that, instead of, let's say, being defined as so much gold, is defined as a market basket of, these, 4 or 10 commodities weighted in a fixed way.
Yes, I would say we had to distinguish two situations. One is once a cryptocurrency is money already, you can find ways to measure price levels, different indices defining your cryptocurrency. The problem is when your cryptocurrency is not money yet. So you don't have those prices in your currency to give you a feedback mechanism. So how you go from not being money to being money, that's the challenge.
Right. Leo, do you have?
Yeah, I think, Arnold, that if for individuals, money is the instrument to facilitate the division of labor, to facilitate cooperation, stability of price is the key value, the key characteristic that money should have in order to better perform that function. But for governments, money is a fiscal tool. And governments, they have coercive power. They have the guns. And they may even have the legitimacy to use the guns. People trust the government with the guns. So what happens is that for a government to relinquish its monetary prerogatives is to relinquish one weapon in their armory that may be necessary to defend the society that the government is proposed to defend, be against internal enemies or external enemies. What happened is that to conceive that any government will relinquish its monetary prerogative, you need to conceive that the government is basically so powerless that they cannot even prevent this basic tool, this basic weapon from being taken away from them. So you need to be in a situation like Ecuador in the 2000s, or some Zimbabwe under Mugabe with $1 trillion bills, things like that. Other than that, I think that the discussion about a possible Bitcoin standard is an academic discussion. It helps us to understand what are the features that a monetary system should have in order to be a good monetary system. The aspects that Nicolás just mentioned about the rigidity of the monetary base under a Bitcoin system. But other than that, I don't think that this can be considered in reality.
Okay. Shelley, is it time to get some questions? Yeah. So
Yes.
if anyone, okay, go ahead.
We don't have anybody currently, but please feel free to raise your hand if you have a question for one of our panelists. So looks like we have Kevin. Give me 1 second. Kevin, if you'll unmute, please ask your question.
All right, I should be unmuted now. Can everybody hear me?
Yes.
Okay, I do want to preface this question by saying up front, I have not actually read Larry White's book. It's been on my to-read list for a while, but I can add to that list much more quickly than I can read down that list, which is problems to have, though it's not a terrible one. But one thing I'm curious to know if it's in the book, and if this is something Larry White addresses, and if it's not, just whatever anybody else has to think about it, is a reason I have found to be, I guess, skeptical of a gold standard or returning to one at this time is the fact that something approximating it is available as an option to businesses these days. Companies and businesses can include in contracts what's called a gold clause, which basically ties the contract to gold. So instead of saying payment will be made in X amount of currency, you can require that payment be made in X amount of gold in whatever currency that matches. And from what I understand, that's almost basically never used. So I would have to suspect if gold was uniquely good at facilitating these sort of transactions and providing stability and all this other stuff, companies would be using that. So are they, does that have the implication I think it does? Am I overlooking something, or is it maybe a great idea and all these businesses are just leaving these $20 bills on the floor and not taking it up?
I guess my first thought is that, there are a lot of, we've talked about transaction costs, and that would be a transaction cost, right? To design that contract and then follow that contract. If dollars are stable, if we weren't experiencing high or variable inflation, the dollar were stable, there'd be no reason to do that, right? I mean, it's just it'd be superfluous. It would just create a lot more friction in markets. So what that says is that if you keep your currency reasonably stable, people will just stick to using the currency as the unit of account, the means of payment, and store of value. When it starts to break down, especially as a store of value, then you will see alternatives. So in other countries, you will see transactions in dollars. Also, I think what we're going to see, and probably have started to see in the United States, is a shortening up of contracts, where somebody, instead of saying, well, you can you can deliver so many dollars 5 years from now, they're going to say, no, we're going to renegotiate this every year. The classic thing being a mortgage. The tradition of this country was a fixed rate mortgage, but as soon as you get to high and variable inflation rates, people start to look at adjustable rate mortgages again, because you can't maintain this a particular price or forecast price for a long period of time. So I think this kind of gold contract that you're talking about is sort of would be the ultimate symptom of a loss of confidence in the stability of the dollar.
This would be, Arnold, an example of that separation of monetary functions that you started the discussion today. In the 70s, here in the United States, when inflation was high, a significant number of commercial leases had indexation clauses. So every 3 years or every 5 years, the lease would be adjusted by the CPI. Nowadays, still you find those contracts. They are relatively common. And I predict that with the inflation remaining higher than in the last 20 years, the number of contracts with price indexes clauses would go up.
I agree with everything was mentioned. I don't know much about these clauses in these contracts, but if you are in a business transaction, what you expect to get is payment in money. So gold may be like a safeguard just in case something happens. Let's say you are transacting with a company in Argentina. In Argentina, you have capital control, so this person may not be able to get dollars, so you allow through the contract to be paid in something else. In something else that is liquid enough in the market that you can then sell, and it's a fairly, good at storing value. I don't know if I see, because of this, gold being money. In my mind, for every person, money is when I walk into Starbucks and I want to buy coffee, what can I pay you with? And gold is not there yet, Bitcoin is not there yet. And that's like a conceptual or graphic way to try to see what money is.
Shelley, do we have any others?
I don't, and I was just going to ask Kevin if he had a follow-up question that he'd like to ask before I release him.
Actually, yes. Tying back to one of the points that was raised earlier about how the gold standard is an international standard. I wonder if also that's a point of concern in that how individual nations manage their gold standard has impacts across other nations as well. One historical and one contemporary example that come to mind, Doug Irwin, some number of years ago, wrote a paper. I can't remember exactly what the title was, but I'm sure somebody could Google it. Basically arguing that a large part of the impact on the Great Depression and the gold standard's influence on that was actually due to France, because they started hoarding and stockpiling gold. That in the few years before, they had, I think this is vaguely what the numbers were, something like 6% of the world's gold supply. And then within a few years, they had 26% of the world's gold supply. So 1/5 of the world's total gold supply that was being used as the base of the monetary system was absorbed into this one country in a fairly short time, which had an impact on other countries whose monetary systems were tied to gold. And a more contemporary example is, I think, the third largest gold producing nation in the world right now is Russia. And if you are on a gold standard and your country's monetary system depends on new gold production, that could give, say, a country like Russia a great deal of influence on how your country's monetary policy would operate, which could also have regrettable side effects as well. So do we think that the need for some kind of international cooperation standard, everybody follows the same rules, is something that we'd be able to count on to provide the stability that it needs, or was that ever the case, or has that always been an issue?
In terms of the France, that goes back to what Leo was saying. That a problem there was that the UK went back to an old parity. When trade restarts in France, and I get all these British pounds, they say they're gonna, give me so much gold per pound, and then I start to suspect and know that they don't have that gold. Then I'm gonna say, here's your British pound, give me the gold, because that's what you just promised, and I don't want to be, last in line, and then I don't get my gold, which I need to make my transaction, because that's the international money. So I think the problem was more the UK than France, right? They set up the price wrong, and yes, you're going to have these international effects. And I didn't go into details, but that's what I meant when I say the breakdown of the gold standard in World War I, and they think the way they put it together triggered a chain of events that eventually led to the Great Depression. The US had to react to what the UK did with their conversion rate, and that was like a whole chain of issues that eventually broke down. In terms of Russia, so if Russia is a major producer of gold, well, I imagine they will import a lot of goods from the rest of the world, and that's good for them, and that's good for the rest of the world, and now they have a customer. If gold depreciates too much, you always have a chance to transform that gold coin into something else, like rings, jewelry, and you take that, the market takes that out of circulation. It's a slow process, but it's a market process to stabilize that value of gold. So I don't know if I have, for the long run at least, major concerns. It's a good question. I don't know. I'm not saying that's my definite answer, but my intuition tells me there are ways for this to be minimized.
Also, there's an issue of the denominator. If you're looking at Russian production versus total production, it's high. If you look at Russian production versus the stock of gold, it's not so high. So it isn't.
Yeah.
So
Right, stock versus flow.
Yeah. So we will have to see the whole stock to have an idea of Russia's impact. And in terms of cooperation, the main rule you need is the same one you have between checks of different banks. If I give you a check for bank account in Wells Fargo and you deposit that at Citi and the check says $100, you need to see $100 in your bank account. So that's in simple terms, the gold standard internationally. I see a British pound that says so many gold, and I deposit this in France, and the gold needs to be there, and so on. So that's the basic rule that should be in place. I don't know if I necessarily see some kind of international organization having to oversee this.
And as Leo says, it's also the domestic prices that have to that have to adjust. So if you do what the UK did and make the parity unrealistic, the only way that parity can become realistic is if the British prices fall heavily, and they didn't, and that but that isn't so much international cooperation as getting things to work within the country.
So let me call this now the equilibrium price between UK and US is out of equilibrium because of how the UK went back to parity, and the price level in UK cannot go down, then the US has to react. And that's one of these chain effects I mentioned happened back then.
Great, thank you, Kevin. I'm going to allow Bill. He has a quick question. Give me 1 second, please.
Isn't the problem with the gold standard that it's essentially deflationary? Or is that a problem?
Okay, so the idea is if economies are growing and the stock of gold is relatively constant, then you have to get deflation in order for things to work. I guess the question is how fast the deflation would have to be. and it might not. But yeah, I guess that would be my first thought on that. It might be that if you only needed, if the economy is growing, well, even that may not be that much of an issue. I mean, if the economy is growing, then it's just in real terms, and it's just growing in real terms.
To assume that the gold standard is by definition deflationary is to assume that the production of new gold will be at a lower rate than the production of all the goods and services in general in the economy, that the economy would, the growth would be, say, 3%, and the growth in the monetary gold will be only 2%, something like that. But even if that's the case, even if there are long periods of time in which the production of monetary gold is 2%, and the growth of the economy in general is 3%. We can, under fractional reserve arrangements, there will be a demand for money substitutes that would help to alleviate any deflationary pressures. One of the things that Larry comments in his book that is, for me, one of the most insightful and intriguing ideas in the book is that, according to Larry, that there is a kind of automatic equilibrium between at the risk of misrepresenting Larry, I would say that, that there is, say, a representation in the level of productivity of gold mines that resemble the productivity of the economy as a whole. So if you take a long period of time, relative prices, the relative price of gold versus everything else tends to be stable. And that, if that's true, it would be a very compelling argument in favor of the gold standard. I don't know it is, but that's my understanding of one of the arguments that Larry presents in his book.
Let me add a couple of things. One is, I mean, it's a very good question, but we need to separate, I think, different types of inflation. Why there is inflation? One reason for inflation, and this is the bad one, the one that we don't want, is if the amount of money supply falls short of money demand. So if money supply is not matching how much money I want to hold, I need to cut down my spending to increase my money balance. That's the bad inflation. The other type of inflation is when prices go down because we produce more goods. If we look at the price of computers, mobile phones, and so on, in the last 20, 30 years, they're in a clear decline in real terms, and I wouldn't say the industry is in a crisis. So the fact that you see periods of time where the price level goes down doesn't mean it's a bad thing. If the reason why that happens is because productivity is going up, or we are producing more. And that's what you start to see when you compare levels of output with price levels. The deflations that we associate with the bad ones, that happens more once we have central banks. So if you make a table and you count episodes of deflation and you put a check, bad one, good one, most of the bad ones happen under central bank policies, and most of the good ones happen with gold standard. So how does the gold standard manage in the short run to match changes in money supply to money demand? What Leo just mentioned, an increase in the supply of money substitutes. That's where the role of free banking through fractional reserve, bankers competing issuing money substitutes is able to match faster in the short run a change in money supply when they observe a change in money demand. In the long run, you have the price incentive where I want to produce more gold. So if you look at explorations back in the day, trying to find gold, the gold rush that we see in the movies, most of them were incentivized by a shortage of gold. So they were trying to fix, unintentionally, a market disequilibrium. The case where we find gold by accident that will be inflationary, those are the minor cases. I think it's a very good question because you're looking at the long-run stability and cost of the gold standard regime. But when I start to separate why you have inflation and how the system reacts in the short run and in the long run, and I compare that to historical evidence, I don't think that was a very serious problem, a major problem. It seems to be that central bank mistakes are actually more costly than real-world, inefficiencies of the gold standard.
Well, thank you, Bill. And Kevin has our last question of the day. Kevin, when you're unmuted, you're ready to go.
All right. Yes, the question about deflation also brought this to my mind. Wouldn't it be the case that the main potential problem with deflation, at least right now, be its impact on expectations about the value of money going forward? So, I mean, you can construct a model in a hypothetical world where under a gold standard, the money supply grows by 1%, but productivity increases by 3%. And then you have kind of a consistent price deflation over time as we're producing more and more goods and prices fall. Or you can have the other side of the coin where, we produce 3% more things and fiat money grows by 5%. And then you have sort of a consistent inflation over time. And the real problem I think I could see would be that in order to make long-term plans, businesses and companies need to have some sort of stable expectation over what that would be over the long term. So as long as everybody, kind of consistently expects you can see about 2% inflation per year over time, they can work with that. But as was mentioned earlier, because that's been less certain, businesses are writing shorter term contracts and wanting to renegotiate more often because the stability of inflation isn't guaranteed. And so much of what we see right now in the economy is built on the assumption that we're going to have kind of a slow, steady degree of inflation. So if we had something deflationary, while it wouldn't necessarily be bad in the abstract, it would be bad based upon how things are right now because the expectation is for slow, steady inflation. Does that make sense?
Yeah, I think so. I think the general economic theory says that an expected path of inflation or deflation is going to be much less damaging than an unexpected path. The only caveat I would give to that is that when inflation is high, it doesn't remain steady. It's variable, and we've seen that just with the recent inflation, where it's 9%, it's 4%, and people even argue about what it is because it's the measures are sort of arbitrary. So some sort of stable money, if it people will adjust to it. But if you have a high inflation environment, you're not going to have a stable inflation environment. But ultimately, yes, if you do get a stable, small deflationary environment or a stable, small inflationary environment, that shouldn't cause too many problems. But that's a reason to avoid high inflation because high inflation is almost invariably variable. All right. If we don't have more questions, we're kind of at the end of an hour. I thought this was a very, very useful discussion. I got a lot out of it. So I'd like to thank Leo and Nicolás for their participation.
My pleasure.
Thank you for the invitation.
Yeah.
Thank you, gentlemen, and thank you everyone for joining us today. Look forward to our July announcement for our From the Shelf with Curator Arnold Kling. Hope everybody's having a fabulous afternoon. Thank you.
Bye.
Bye-bye.